Okay, Martin Godfrey Legido here, chartered accountant, investment banker with a lot of M&A experience from PwC and others, along with our team at Acquisition Assist. Now today I want to talk about funding of an acquisition. Many of you may be interested in buying a business. I've done other videos to explain why it makes sense to actually buy a business as opposed to starting one, and that there are thousands and thousands of businesses out there for sale. But is it easy? No, it's not easy. You've got to work at it and you've got to be really persistent. And we only like to work at Acquisition Assist with clients who are really, really persistent. And if you are persistent, you will succeed. If you're prepared to just meet a couple of people, talk to some people, and not really go for it, then it won't work for you. You've got to really, really try hard. Why? Because it's a very competitive market out there. Thousands of businesses for sale in the developed world, the United States, the UK, and more and more. And there is competition to buy. So what I want to talk about today is the funding, the financing of a business purchase. So let's get started. And I'm going to say right up front, if you like this kind of content, please press the like button and subscribe to help the channel to grow so we can get you more and more useful information. Thanks very much. Right. Okay, so how do we go about funding? There's a lot of misinformation about this. There's a lot of BS about this. There's a lot of disinformation. So many people are confused. Are we looking for your personal money? Typically, no. We always go to finance using the assets in the target business, the business you're looking to acquire. There's a lot of businesses for sale, but be careful because there's a lot of misinformation and disinformation about how you can do this. We have the experience, we are ethical people, we are chartered accountants, investment bankers, we are controlled and legislated, so we can only get to you with the real information, the correct information. So let's start, and I'm just going to throw some terms at you right now. Remember, we're only looking at the funding of the asset itself, the target business. Your own funding can come into it. If you have money to invest, that's all good. It's all helpful, but not 100% essential. So firstly, we have asset-backed lending. What is that? It's lending based on assets. You'll all be familiar with mortgage lending. You'll be familiar with taking a mortgage on a residential house for an investment or for your own to live in. And asset-backed lending is similar. We're talking about, what are we talking about? We are talking about real estate, bricks and mortar. We are talking about plant and machinery in the target business. We are talking about motor vehicles in the business. We're not talking about various leasehold assets that you will find on a balance sheet, and we're not talking about fixtures and fittings, okay? It's a limited but very important class of assets. Now, that assumes, of course, that there is already no financing on the possibly property, plant and machinery, motor vehicles. If there's a fleet of trucks, for example, then there may well be some financing. If the financing is not too much, let's say you've got £1 million worth of trucks and small vans in a transport company, and it's only got 200,000 of financing against that, then that still leaves 800,000. We may well be able to finance some of that. So that's one asset class, asset-backed lending. There can be sale and leaseback of real estate and assets. So you can actually sell and then lease it back from the person you've sold it to or the company you've sold it to. And that means that you can actually generate funds from the sale and leaseback activity. And you end up, of course, with a lease to pay, a rental to pay. But that could be beneficial to the company. There's overdraft from legacy banks and from new banks. Small firms loan guarantee scheme, or the latest version of whatever that's called in the UK. In the States, there are loans you can get for small companies, which are really, really helpful. And there's a lot coming onto the market. the economy well, it depends on who you're speaking to, but I would say the economy is still in pretty good condition in both the States, the UK and other jurisdictions. So you need to check and Google what kind of small company loans are available to you. Factoring, the next big asset class to work on are the debtors, the customers, the debts owed by the customers to the company in the target business. Okay, debtor financing can be factoring. That's where the debtor book is taken over by an external finance company, for example BB Factors, and the debt will be assigned, all the new invoices will be assigned to that factoring company, and they will pay up to 85% to you running the business for factoring. And of course there's an interest charge which could be probably around 8% at the moment as we speak. Now that's quite good because you don't have to pay back that amount. It's constantly rolling through the debtors, and it's a very, very important asset class. There are other forms of debtor financing. There can be confidential invoice discounting, which means the invoices are discounted and paid to you, but it's done confidentially. Go into that on another time. There can be spot invoice discounting. Let's say you've got revenue going through on a normal an every day and every week basis, but then maybe somebody wants to buy a big item, a big capital item, and you can actually spot finance, in other words, finance on that particular asset. So that is factoring. Cash flow funding. Cash flow funding comes there's different sorts of cash flow funding, and it's a bit more esoteric than your average asset-backed lending. Cash flow funding can come where a finance company will actually look at a business and see that it's turning over a good cash flow, turning over good profits, and they will look at individual assets, but overall they're looking at the whole company, and often they will want to take a debenture security, a charge on the shares of the business, on the actual business itself, and they're prepared to fund on that. It's difficult to say what percentage. It depends on each individual business. Bridging funding, some of you will be familiar with that from real estate transactions. Bridging funding is short-term funding, quite expensive, typically 12% and above, but can be used for certain sorts of funding. For bigger deals, mezzanine funding can come in, mezzanine finance, and that's where you've got a longer term finance underneath and shorter term mezzanine funding, but not as short as bridging, can be brought in to actually finance a deal. And there are special class of funders, mezzanine funders, that will do that. Peer-to-peer lending, again, you probably know something of that. It's a growth sector. There's a lot of peer-to-peer funding. It's quite difficult to use that for larger purchases. It normally could be for startup funding and smaller business funding, but it's there, and it's a sector which is changing the whole time. Now, on to the big kahuna. The big kahuna is vendor financing. And just before I talk about vendor funding, let me just finish off with royalty funding, order book funding. Royalty funding is where there are royalties in the business, let's say a book publisher or a music publisher, and royalties are coming in. You can actually get finance against the future stream of royalties coming in. And order book funding is the other way around, where if you have a strong business and you have a strong order book, you can go to a lender and say, look, we've got these blue chip companies and they're buying from us, and they've placed orders for often big capital items, and you can get funding against that. And as I talk about funding, nothing to do with clicking the like and subscribe, but please do that to help us carry on. It helps the algorithm, and it means that we can actually bring you more and more useful information. Now, vendor funding is the last one I want to talk about, and that's the big kahuna. Okay, what do we mean by vendor financing? Very, very difficult in real estate, apart from some commercial real estate transactions, but in business, buying and selling. It's absolutely normal. Vendor financing is where the actual seller will help you to finance the purchase of his business. And I cannot stress enough, if you don't take anything on board other than this, when you go forward, vendor financing is used in virtually every transaction. It is expected. Yeah? It comes in two forms. Typically, guaranteed deferred consideration, which is where you pay a certain amount, let's say a £5 million business, £1 million is paid on completion of the signature of the deal. That typically is financed from the business itself. It might come from an equity funder, it might come from somewhere else, but typically on the assets itself. So you've got £1 million in there, and then the balance of 4 million is going to be paid over a 2 to 5 year period. That is the vendor financing. Deferred consideration is typically codified, set down, that so much will be paid every quarter, every 6 months, every year. And the second form of vendor financing is called an earn-out. In the Republic of Ireland, they call it a put and call option. Can call it that. But an earn-out is the term mostly used. And that means that we set targets for the business in the next 2 to 5 years. And if those targets, profit targets, are met, then so much is paid. In other words, it's earning out from the profits of the business. Now, this is very good to protect the interests of the buyer. The vendors don't always like it so much. It depends, because it means that the actual payouts are not guaranteed. But it's a very, very important factor. So I've talked about asset-backed lending. Remember that office fixtures and fittings, if you're looking at a balance sheet of a company, fixtures and fittings are not really financeable. And any old assets, if you're talking to a manufacturing company where, for example, they've got heavily depreciated machinery that's producing whatever widgets, yet if you can see on the balance sheet that that's been heavily depreciated, it's probably old, and that probably means that you can't really raise much on it. But normally up to 70% can be raised on decent assets which are not too depleted and obsolete. Okay. Just a further few words on cash flow funding. You can't really combine debt funding, factoring, or confidential invoice discounting with wraparound cash flow funding with a debenture. Yeah, you can mix asset-backed lending with factoring. That's fine, but wraparound cash flow funding on the whole business with a debenture will not work with factoring, because one of the main assets of the business are the debtors in the business. Yeah, sometimes it can work with asset-backed lending if the two can be separated. Yeah, and it can sit side by side with asset-backed lending. Interest rates are normally quite high, and they of course are varying the whole time. I mean, as we speak, you're talking somewhere between 8 to 12% per annum, so it's not the cheapest form of funding. Factoring can be taken, as I've said, up to around 80%. And remember about factoring, you could only get factoring on B2B, business to business. Now, if, for example, you've got a double glazing company installing double glazing, and let's say they're turning over, again, well, let's say 3 million, and half of their turnover is into residential, Mr. and Mrs. Smith living down the road, that part of it cannot be factored. It's only business to business. Why? Because you can't really credit check Mr. and Mrs. Smith easily. Yeah, you can check them, but it's too fragmented. What lenders want are good quality business customers who they can credit check over a number of years, who are responsible and have been paying their bills correctly. We have systems that go into this very quickly, and we can tell the creditworthiness of a potential business customer. I've already mentioned confidential invoice discounting, so I won't go further into that, but the B2B thing is very, very important. And also, when you're looking at something we have to check every time we look at the hundreds of businesses that we analyse, when you see on a balance sheet debtors, always go into the notes on the balance sheet, because you will often find, let's say there's £500,000 worth of debtors, you will often find that they're not all trade debtors. You might have £300,000 of loans concerning a third party, and maybe only 200,000 of trade debtors. So it's only the trade debtors that can be funded quite clearly. So royalty and order book funding, they're normally on bigger deals, £5 million plus or $5 million plus. Typically you don't need personal guarantees. Just like cash flow funding, you do not typically need personal guarantees, and you can get the funding up to 25 years, which is pretty cool. This is royalty and order book funding. And really, you know, they have to be big customers, credit-worthy customers, blue chip customers, typically, yeah? Remember that cash is king, yeah? And that the business must create a good cash flow. Including any debt raised to actually make the first payment, and also deferred consideration. The business profits must finance everything. So it's all very well saying, yeah, we can raise £2 million on a business, but how is that debt going to be funded? The debt service, we call it, okay? Leaving aside factoring, basically other debt that you raise, you're going to have to pay back the capital, maybe over 10 years, and the interest. So we always calculate what that's going to be, what the debt service is going to be, and to make sure that the company can handle that and pay that. You don't want to be paying that, do you? So that's another important point that we always raise at Acquisition Assist, to ensure that the whole debt can be funded by the business. Yeah. And you must be ready to walk away if the deal doesn't stack up. And they don't all stack up. You know, sometimes you'll have a business with a very, very valuable balance sheet, but not much on the profit and loss account. It's not really creating much profits. Sometimes it's the other way around, and you'll have a very profitable business, but hardly any assets. So there's not really any assets to fund, and yet there is money to pay for any asset funding. The other way around, you know, you would struggle to actually fund anything. So don't get too fixed on a particular deal. You have to look at quite a lot of businesses when you're going along here, and the funding is absolutely, obviously crucial. And you always want to avoid personal guarantees without any shadow of a doubt. Personal guarantees can be avoided by giving a guarantee on the shares of the company itself. Yeah, it could be, you could give a guarantee, a debenture, to the previous owner if they're concerned about actually the security on future and vendor financing. You could give a debenture on the company itself. You could give security, a charge on a particular asset. Let's say they had, you know, 5 very valuable trucks worth £500,000. You could give security on that. Another way around having to give a personal guarantee would be only to acquire the shares of the company in tranches. So to start off, you know, you might acquire 30% and then another 20% and so on. So as you pay for the business, you acquire the shares. Again, a good lawyer will put that together for you. So there's many ways around a personal guarantee. So we've gone through a lot of these notes that I have here. I think cash flow and hybrid schemes are useful. So due diligence is really, really essential. What is due diligence? Due diligence is really looking into the assets and the trading of the business. We do that. We are accountants, and we make sure that the business is being run properly, that no that everything is accounted for in the accounts package, that there are no undue creditors or liabilities that could come out after the acquisition. And yeah, due diligence really must be done before the financing of the finances can be done. And we need to be sure that everything really has the value. If you're looking at asset-backed lending, we normally get in an asset valuer who will do a hands-off valuation of the business. You can't rely on what the vendor is saying. In stock, for example, there can be obsolete stock which needs to be discounted in terms of valuation and so on. So I think that's really the summary. We have access to probably about 1,000 different funders. And again, if you like what's happening here, please click the like and subscribe, and we can get you more information. We do recommend, by the way, that some of the new challenger banks are worthwhile going after. Resolute, Starling and others. They're good. They're obviously more hungry for business than the older style banks. Be very careful when you're getting lending on assets. Be careful about the fees involved. They can be high, so you need to check that, and that has to be paid, of course. Just be very careful, make sure you're properly advised to make sure that the funding is appropriate and the debt will be serviced. So I think I've gone on, repeated various points, but as I've said in other videos, repetition is worthwhile to make sure you fully understand. Once again, if you want our full free course on mergers and acquisition, click the link below and we will get you that, and that will help you on your road to an acquisition. Thanks very much. Martin signing off.